There are investors who are just waiting on the sideline. And as you pointed out, what's been really nice to see over the last 3 months is every one of these Bitcoin, drawdowns, if you will, have been quickly bid up. I mean, even today, as we're talking, Bitcoin's back above 112K. And it's in matters of now days in which these 1,000 point swings are happening to the upside. And so there's definitely a bid. I think the bid's only going to get stronger. And as we know, when Bitcoin goes up, there actually tends to be more interest in people wanting to not feel like they're missing out. And that cascading effect ultimately draws more people in.
What's going on, guys? Today we got a great episode with Jeff Park. Jeff is the Chief Investment Officer and Partner at ProCap BTC. In this conversation, we talk about why Bitcoin is not a bubble, but it may be the pin. We talk about the rotation from gold into Bitcoin, what Bitcoin whales are doing by taking spot Bitcoin and contributing it into the Bitcoin ETF. And then we talk about the acquisition by Coinbase of Echo and what that signals for retail investors and institutions alike. That and much more in this conversation with Jeff Park. All right, Jeff, I thought a great place to start is you had this amazing tweet. You said, how could Bitcoin be a bubble if it's the pin? Explain this.
I keep hearing people saying Bitcoin's a bubble and that we're near the end of the 4-year cycle and therefore we need to be tactical about asset allocation. And every time people bring up that point, I can't understand it. And I thought long and hard, like, why is there such a gap between our understanding? And I think it's because of exactly what I tweeted. How could Bitcoin possibly be in a bubble if it's the very pin that I think is actually unleashing the bubble itself, which is the entire economy based off of fiat? Mm-hmm. And then someone said, if Bitcoin's the pin, then what is gold? Isn't gold the pin? And I thought about that too. And I think actually the analogy there is gold is maybe the air that you're putting into the bubble as well. Because the entire fiat economy, I think, is ultimately based off of the foundation of gold as well, being the store of value. So the bubble in the stock market and gold actually have a pretty meaningful relationship because gold is not in itself a useful network. I do think of Bitcoin ultimately as the definitive pin because it is just unwinding all of that inertia into thinking about money very differently, which is that money should be not permissioned. It should also be freely movable. And there's something about money velocity that changes with Bitcoin that is just not related to even the way gold exists in the physical world. I think also in the conversations, we often hear about the regulatory concerns about Bitcoin, not just being the store of value in itself, but also the speed in which transactions can happen being a systemic risk to the financial stability and how we need circuit breakers as a result. Because I mean, part of the entire world that we live in have these circuit breakers because we don't want money to actually move that fast. Because if money moves too fast, it actually changes the foundation of the idea of credit, right? Credit can only exist if money is actually dormant at some level. And that's why asset liability matching is the ultimate puzzle that everyone is involved in figuring that unlock. And Bitcoin, it just moves and there is no queue. There is no unlock. It actually is money in motion. And if that's what Bitcoin represents, then to me, that's the pin. Everything that we've ever known about the construct of money and store of value is changing with Bitcoin.
Do you think that there can still be, 50, 75% drawdowns in Bitcoin? Or do you think that because we have seen muted volatility to the upside in this cycle, I think this is the worst performing bull market in Bitcoin's history, that we should also expect muted downsides as well?
I think muted downsides is probably the right approach, mostly because there is a strong institutional bid on the back end. The ETF as a capital formation technique is novel for Bitcoin and that we haven't had historically before. And I don't think we should discount how important that institutional floor and bid is. The idea that all our retirement accounts, for example, can own Bitcoin at an attractive price. And there could be folks out there who are still waiting on the sideline and they're willing to put in limit orders on their retirement accounts, their IRAs, to say, hey, I'll buy Bitcoin when it hits 70K, 80K, whatever that number may be for them to feel that threshold gives them comfort. That institutional and retail bid just never existed before the ETF wrapper. So I think structurally the market has changed. That being said, I do think there will be drawdowns. I mean, all commodities have drawdowns. And again, it's because price discovery is the most natural thing that the market should support for, both when there's demand, but also when there's supply in ways that there's more sellers than buyers. But what's unique about Bitcoin is we know for certain there's at least no new supply that is coming online that isn't coming from the secondary market, at least at the pace in which historically it existed. So part of why I think the 4-year cycle too is something to be dismissed is because historically it's absolutely true that there was new issuance of Bitcoin in the past that was hitting the market that isn't coming from the secondary buyers and sellers. But as we know, over time, that issuance calendar has shrunk massively and the block rewards are very small. And in the context of how small the block rewards have gotten versus how large the TAM of buyers that are entering the market have gotten, there's no time that's been like this, where I think the 4-year cycle itself is definitely written for history.
Because you're basically saying it used to be there was more of a block reward in terms of size, but the buyer pool was small. We've actually had two forces here.
Exactly.
The block reward come down, and you've had the pool of buyers go up, which swings kind of that like persistent bid for the asset.
100%. It's a double whammy, because back when Bitcoin was being newly supplied, the miners did actually have to invest in their capital expenditure to continue their perpetual business of mining, which meant that there had to be some organic selling pressure. And that organic selling pressure is institutional because these are well-capitalized businesses involved in actually scaling this to a greater extent. And that supply was meaningful relative to how all the existing Bitcoin traders were conditioned to know that supply was inelastic, right? When you know miners are coming because they have to sell to fund their debt or their CapEx spending for the next 5 years, and they're price agnostic because they need the cash, that's the kind of like selling pressure you don't want to be ahead of, right? So it's very logical to me that a sensible crypto investor would then say, I want to get ahead of it and sell before the miners come and stuff like that. This is perfectly sound. But the reality is that pressure has decreased. And now there's actually more buyers coming in who are not those tactical traders that are trading by the cadence of these cycles, but they just want to own it for a long period of time.
The other thing I think is interesting is people are very focused on, will there be drawdowns? So it sounds like yes, but muted is your answer. How long they persist, I don't hear a lot of people talking about. And so historically, we've seen these drawdowns be a year and a half, 2 years. I mean, pretty long time periods. More recently, these drawdowns, although they haven't been the 75% kind of bear market drawdowns, they've been pretty quick. How many times did we trace back to 85K and we're back to 100 within, a week? Recently we went from, 120, 125,000 down to 105, and then we're back to 115 pretty quick. And so do you think that there's also that persistent bid will negate the length of the drawdowns as well, not just kind of the severity of them?
I think it will, because ultimately there are people who just want to build these positions and haven't been actively doing it because they are waiting for the right entry point. We used to have these conversations at my prior firm with Bitwise all the time. There would be investors who are, one, convinced of Bitcoin, they now understand it, but they look at the price and they say, it's actually just too high. I don't want to buy it at this point. I'll wait for a better entry. You'd be surprised how many folks think that this tactical kind of alpha generation by waiting would be to their advantage when most often they're not. And so there are investors who are just waiting on the sideline. And as you pointed out, what's been really nice to see over the last 3 months is every one of these Bitcoin drawdowns, if you will, have been quickly bid up. I mean, even today, as we're talking, Bitcoin's back above 112K. And it's in matters of now days in which these 1,000 point swings are happening to the upside. And so there's definitely a bid. I think the bid's only going to get stronger. And as we know, Bitcoin is a bit of a momentum asset. When Bitcoin goes up, there actually tends to be more interest in people wanting to not feel like they're missing out. And that cascading effect ultimately draws more people in. But these same investors are actually pretty risk averse and they will not sell on the way down. And so what you end up happening over these cycles is you slowly move up the cost basis of the total network over time. And that creates these new floors. And so it is cyclical. But what you want is more money coming in at higher prices over a long period of time. And those trends have been intact now for quite a many years.
Gold obviously has had this epic run in 2025. It's up about 60% or so. It feels like there was almost a euphoria to gold. I wrote earlier in the week that maybe it's time for the gold to Bitcoin rotation. That there is kind of the hardcore gold bug who will never sell, just like there's the hardcore Bitcoiner. But I do think there's some momentum trading in gold as well. We know that there is a relationship between gold and Bitcoin. About 100 days after gold runs, usually Bitcoin runs. We also know there's this year-end chase that people love to talk about. We know that Q4 is really good for Bitcoin. There's a couple of things that start to line up that suggest maybe actually, although Bitcoin maybe has disappointed people in terms of it not going up as much, don't say never. Don't get lulled to sleep here. Is that how you view this?
Yes, I do. This is maybe hitting back on what we shared earlier. Gold is an altcoin for Bitcoin too. And today's a good day. Gold's down, I think, close to maybe 4%, maybe even a little more.
It's
actually the biggest drop in a long time. And on the other side of it is we're seeing a microcosm of Bitcoin's outperformance in that environment too. It's one day, so you can't really read into it too much. But I think there's enough reasons to believe that people are generally looking for rotational momentum, and gold was driven by momentum. Its RSI was above 70 for months. I mean, I don't think gold's ever seen anything like it. I've personally never seen RSI on any asset stay above 70 for as long as it has for gold over the past 2 months. It's incredible. And then the options market too. I think gold basically blew up in the volume of options market in the last week. I think the most number of calls on gold was ever traded last week. So there's definitely euphoria. There's definitely momentum. But eventually these things catch up. And I think then people do look upon, well, what's the next best thing that we can rotate into for the next leg? And I think it's so obvious to folks that Bitcoin has been lagging generally in all the other liquidity indicators that people have expected. So it's the most rational trade. And so I think these are kinds of the moments when Bitcoin can just shoot up really, really fast. I mean, I think there's going to be a moment in time when we're going to blink and gold and Bitcoin will have basically kind of shown that move where Bitcoin catches up.
Today's episode is brought to you by Bitcoin IRA. Are you a crypto investor with a retirement account, but don't have any crypto in your retirement account? Listen up. This is for you. Bitcoin IRA is revolutionizing the way Americans save for retirement by helping smart investors diversify their savings with access to over 75 cryptocurrencies. With world-class customer service, military-grade encryption, and a vertically integrated licensed trust company, it's no wonder more than 200,000 Americans trust Bitcoin IRA to secure their financial future. Get started. It is quick and easy. It takes just 3 minutes to open an account. Once you're set up, their team of IRA specialists will reach out to guide you through every step of the process. Whether you're transferring an IRA from a legacy bank, rolling over an old 401k, or starting fresh with a new contribution, the Bitcoin IRA team is here to help you get access to real crypto in your retirement account. And here is the best part. As a Pomp podcast listener, you can earn up to $1,000 in rewards when you add funds to your account. Search for Bitcoin IRA in the App Store or visit bitcoinira.com/pomp to join 200,000 Americans on their journey to upgrade their retirement. That's bitcoinira.com/pomp to upgrade your retirement today. Yeah, it's interesting. I was talking to Peter Schiff, who I love, and he was talking about gold's performance, and I think at the time gold was up like 60%, Bitcoin was up like 18-20%, and I said to him, could Bitcoin catch gold this year? Like on December 31st of 2025, could Bitcoin have actually outperformed gold year to date? I don't know, right? But Bitcoin can move, man.
No, and Peter of all people should know how strong these moves can be in a very short period of time, because gold as well, even though it has now done very well, and if you kind of measure its outperformance versus even the NASDAQ starting from 2008, it is true that it is actually catching up and maybe even outperformed the NASDAQ in that time frame. But it's really due to specific windows of that ownership. For instance, if you go back even further to like 2002, I think, it would have shown you like gold performance is still like sub 3% per year. And so all of these kind of trades with macro constructs on store of value is very momentum driven. So if gold can catch up for all its underperformance for decades by having an outperforming year like this one, Bitcoin's timeline just compressed. It won't take a year. It'll just happen in weeks, maybe even days. And that's why I think Peter's not wrong. It's just Bitcoin's the faster horse. And part of why Bitcoin is the faster horse is because it doesn't have the same circuit breakers that the market structure of a physical commodity does. Anyone can buy at the moment that they choose on code. And there is no logistics, there's no warehousing, there's no seeking of supply, there's no futures that you otherwise have to allocate for. It's literally just something you can go on Coinbase or wherever and hit the buy button. Yeah, and you're participating.
It makes so much sense. We're talking about gold rotation to Bitcoin. The other thing that's happening inside of Bitcoin is rotation from spot to ETFs. Now, historically, this was not possible because you couldn't do in-kind contributions or redemptions. That has now since changed. And maybe explain in-kind contributions just for those that don't know, and then talk about why some of the Bitcoin whales are actually doing this in-kind contribution.
Yeah, absolutely. To understand in-kind contributions and redemptions, we have to go back a little bit more in history and understand where the mutual fund, the ETF industry came from. And mainly the 40 Act basically deals with mutual funds. And mutual funds was innovative at the time, for which you were able to create a co-op model to invest in a variety of index exposure or actively managed exposure to outperform the market. And it's an access vehicle, and it's really driven by the interest of providing investors more options to find professional money management that they can outsource. So it's very democratizing. It's very good, I think, for high net worths and retail investors. And then ETFs took it one step further, which was there are some flaws with the mutual funds, which is basically it's not really tradable intraday. There's no price discovery, and doesn't make it easy to contribute in-kind assets into just having more pure form of that financial asset as the thing you want to own. And so the mutual fund industry is obviously humongous. It's in the trillions. I want to say it's like $30 trillion industry, but the ETF industry has caught up. And even before the launch of like Bitcoin, it was basically a big wish from the ETF industry since as early as 2008 that we should find a way to have the ETFs exist more nicely within the 40 Act construct, because ETFs have to ask for exemptive relief to get each of these products online from 2008 and beyond. And people were saying, this is pretty simple stuff, and anyone should be able to do it without going through that motion, which could take months of delay. And there was actually also like an advantage for incumbents like the BlackRock of the world, who basically had a right to issue these things because they're better at having done it. They can copy and paste the existing languages, and they can just streamline and steamroll anyone ahead. And so a lot of the smaller players thought it was unfair. It favors incumbents, and the ETFs is not a level playing ground. And so what happened is 10 years later, in 2019, for the first time, we actually have now what is called the ETF rule, and it allows ETF issuers to come online without seeking exemptive relief. That there's now like a rules-based way that people can understand how these things work. We know how APs work now. There's enough data points to find clarity. We know how continuous liquidity provisioning can work in that framework. And so all of these things are templates to give everybody equal footing to go and participate. This was a big deal. And that's why the ETF industry has flourished so much. But what the 2019 rule made for was just for 40 Act funds. They did not include 33 Act funds. And Bitcoin, because it's a commodity-based ETP, qualifies as a 33 Act fund. So the issue was, even though the Bitcoin ETFs came online, there wasn't an ability to actually have all the benefits of a traditional ETF that you might be able to enjoy. One of them, the most central one, being in-kind creation and redemption. So as of last, I want to say this summer in July, that changed. And that changed, of course, with APs now being able to market make with in-kind creation and redemption. But a broader point that was missed is any high net worths who have relationships with APs can also come online with their Bitcoin and get that contributed to the ETF wrapper in kind and receive ETFs without there being a taxable event. And you can imagine there's a lot of Bitcoin whales out there who've been sitting on Bitcoin for a long time. They do not want to pay capital gains on those positions just yet, but they also realize the financial utilities that can get from an ETF wrapper, and they want to bridge it without generating that taxable event. And what happened in July this year is now permitting that outcome, which is also why we're seeing such inbounds within the ETF construct taking place. I think BlackRock has said that they've taken in $3 billion or so just in that format of high net worth contribution in kind into the ETF wrapper.
What are some of the financial services or things that are benefits having the ETF wrapper versus spot?
Yeah, there's a quantitative one and there's a qualitative one. The quantitative one is pretty intuitive, which is that in the ETF wrapper, you have basically the ability to participate in the traditional capital markets, that the spot market in crypto has not been developed yet enough to the level of same professional standards. So lending Bitcoin to earn yield has been a very popular and well-tried strategy. We all, of course, know the downfalls of what that can mean in the crypto spot market, especially when you're an unsecured lender. But within the ETF world, because you're playing within the securities framework of actually having a central clearing business, there being a short desk and a borrow desk and buyers and sellers matched in that framework, you're not really taking counterparty risk, right? You're actually just taking the risk of the issuer, which has been vetted at the highest level and at their custodial practices. And you're not actually involved in like rehypothecating the underneath asset. So if you ever wanted to earn yield on your Bitcoin and do it in a safer way, it just might be safer to do it in the ETF format and actually borrow your shares of the securities rather than the spot asset itself. It's one of the reasons why a lot of the large crypto hedge funds have actually chosen to take their Bitcoin exposure in the ETF wrapper than the spot wrapper. The other real benefit too that is less talked about is now you can actually cross-margin that Bitcoin ETF with your non-crypto assets. So if you own Bitcoin in your Coinbase account, that's great. But you're not going to get margin on that position to then go out and buy Microsoft and Apple. But if you were to find a multi-asset prime brokerage model in which the custodians can actually underwrite that risk and give you some of the margin benefits, then you found funding liquidity. And that's a great unlock for somebody who might be sitting on a lot of Bitcoin. And now you can actually find ways to bring leverage into that in the ways that you deem. That's some of the quantitative benefits and features that I think is worthwhile. The qualitative benefit is actually going back to the RIA business itself. RIAs are compensated at some level by providing financial advice to their clients for which their net worth is measured by the assets they bring to the table. It's very challenging for financial advisors to be able to have ownership of your client's Bitcoin assets if it's not part of that conduit in the way that it's meant to speak. So you might have $1 million in stocks and you might have $100 million in Bitcoin, and your FA is not going to give you the treatment you deserve for actually being a super ultra high net worth because he doesn't know how to think about that $100 million of Bitcoin. If you contribute that now into an ETF format and your account value goes up in a way that these financial advisors were not able to recognize, you're now a VIP. That qualitative element can't be underestimated. I think most Bitcoin investors that are super wealthy out there are just not being treated fairly in the same way that they could access credit and financial services otherwise. So that's a really meaningful additional feature for crypto investors.
Today's episode is brought to you by Core. You can earn yield on your Bitcoin by just holding your Bitcoin. It's simple. Core, the leading Bitcoin scaling solution, will reward you for not selling your Bitcoin. It's not magic. Here's how it works. Core is a protocol secured by elected validators. You can help elect validators and secure the network by simply locking up your Bitcoin on the Bitcoin blockchain. No bridging, no lending, and just holding. When your validator secures Core, it earns rewards fueled by network activity and passes them back to you as yield. With a minimum lockup of just 1 day, when the time lock ends, you get your Bitcoin back untouched. Still your keys, still your coins, now your yield. For even higher rates, stake Core alongside your Bitcoin and multiply your yield. And if you want to see what your Bitcoin is securing, join millions of others in exploring the largest Bitcoin DeFi ecosystem. There are over 100 live apps in the network and the deepest liquidity in all of Bitcoin DeFi. Get off zero and start earning yield on even just 1% of your Bitcoin by going to stake.coredao.org/pomp. Again, that's stake.coredao.org/pomp, or go click the link in the description.
Yeah, it's interesting to think about by taking this Bitcoin thing and plugging it into the ETF wrapper. The Wall Street firms have drastically benefited, but a lot of people don't talk about, well, the same thing is available. Now, this isn't for everybody. There's still plenty of people who want to self-custody for good reason, kind of all the normal stuff. But for people who are looking for those financial services related to Bitcoin, this is, somewhat of a bridge, if you will, to that legacy system.
Yeah. To your point, there's pros and cons. If you essentially contribute your Bitcoin into the ETF, you technically no longer are the owners of those coins, which means you can't actually participate on chain in the economy that I think we're also developing and parallel tracking for the vibrant opportunities that are available. So it's a bit of a trade-off. I think most investors would benefit by having allocation to both because you can play in both lanes and they're not mutually exclusive. And I think that's what's been shown.
You can do redemptions as well, right?
You can. But that part, I am not as sure how that would work from the ability to have your tax basis tracked.
I'm sure there's a lot of people who say, wait a minute, are they really going to give it back? Right. The other aspect that I've heard people talk about, and these are folks with very large positions, is security. Right? Is, hey, if I contribute Bitcoin into the ETF, now that ETF sits in my brokerage account, I'm not worried about somebody stealing my ETF shares.
Yeah.
Right. I'm not worried about getting hacked or, whatever, or user error, right? Sending you to the wrong place. Whereas with Bitcoin, I think, one of the things I don't hear people talk about a lot, but I talk to a lot of people every single week. There are still a number of people who say, hey, when I move Bitcoin,
my heart beats a little bit faster.
Yeah.
Right. You know, like I want to make sure that, I'm not making a mistake. I send the test transaction. I, do this stuff. I think ETFs is another thing. Now, again, you're paying someone for that security, right? There is a fee associated with ETF, but I think that there are people who just make the trade-off and say, hey, it's worth it.
Yeah. The premium of insurance can never be underestimated for the human psychology. I mean, I just experienced this yesterday. There was a huge outage with AWS and I couldn't access my MetaMask.
Mm-hmm.
And it was like Ethereum mainnet loading, and you actually couldn't do anything. And even that's scary when you see stuff like that, because you're like, wait, like, is anything that I ever thought I owned actually being now like reachable?
Mm-hmm.
And so crypto has that kind of risk factor always with us. And security is a good one you mentioned too, because I've thought about a lot in terms of like how there's rising wrench attacks happening. And part of the reason why it's happening is because the non-custodial nature of it truly means that they can get your Bitcoin.
Mm-hmm.
Right? All they have to do is really kind of violently threaten you and then get your eyeball to then have you transfer the coins that are basically irrevocable.
Mm-hmm.
Can't really do that with ETFs.
Yeah. I remember Mark Yuska one time told me a story that he had a dream that he went to the ATM and he punched it and it was just like, you have $0. And he was like, well, what would you do? Right. And he was like going through this whole exercise, right? But he was like, just talk about cash, right? Yeah. But he's just like, because it's just an entry in a database, like you would have to argue with them then. Like, no, I had the money. Like, yeah, sir, everyone tells us that all the time, right? Like you kind of go through it and you're like, yeah, well, what would we do?
No, it's super scary. MetaMask always gives me like a little bit of a heart attack because there's every now and then a glitch where it's not pulling up the right assets because there's been some kind of network upgrades and like it just drops out of the ledger and you're like, okay, it's probably there. I don't think I got hacked or clicked the wrong link somewhere, but you do have like these moments where you're just like, oh my gosh, like now I have to spend time on this and figure it out.
Yeah. Last thing I want to talk to you about is Coinbase announced that they bought the $25 million NFT from Kobe. And then the next morning said, oh, and we also happen to buy his company for $375 million called Eco. What I think is most interesting is the NFT purchase got way more play than buying the company, which is kind of a good marketing stunt by the Coinbase team. But talk about this acquisition and why you think it's so important.
Yeah.
Of the company, not the NFT.
What a legend. I mean, what a legend. I think it's an incredible acquisition and Coinbase just continues to show you what they stand for. I think one of the amazing things for Coinbase is how successfully they've been able to marry the disparate interests that exist in crypto under the motto of promoting economic freedom. I think promoting economic freedom is such an incredible way to frame what Coinbase is doing because on one hand, you do get a chance to bring in the hardcore Bitcoiners who want to opt out of the system and they consider that a version of economic freedom. But then there's also those that are like true technologists that just really want to democratize access and open source some of the abilities to transact more openly and freely without guardrails. And when you say you're promoting economic freedom, you can kind of marry both of those disparate causes under one umbrella. And what we saw with Echo is exactly that. I think about Coinbase existing across this X and Y axis about who they serve. And on the x-axis, I would say on one end, there's retail customers, but then on the other end, there's institutional customers as well. And then on the y-axis, you have what I call kind of primary markets to like secondary markets, right? So secondary markets is, of course, they're an exchange. They're in the business of providing value in allowing traders to actually transact. But the primary market is a big part of their business too, which is they're a builder of value, not just a trader of value. And so that's kind of where the ecosystem of the operations that they're building can be a part of. But another way to think about it is the vertical integration across both of those markets, which is what crypto on-chain economy is about, which is what the internet capital markets is really about. And so the idea of actually having a funding platform that can then seamlessly point-to-point connect with the exchange is, in my opinion, the holy grail of rebuilding the financial infrastructure. This also just goes back to how frustrating the entire kind of stock market today is, in my opinion, between the bifurcation of privates and public market. If you think about what really happened over the past 20 years is a lot of companies used to IPO a lot earlier. And so anyone can go and buy the stocks they love earlier. Mm-hmm. And over the last, I would say kind of 15 years, the rule of the game has fundamentally changed, which has been really bad for retail investors, in my opinion. And this actually kind of traces back to one, Facebook, and two, the Jobs Act back in 2011, 2012. So before Facebook, it used to be that there was a limit to how many investors you could have until you had to IPO. It was a 500 investor limit rule. So once you crossed over 500 investors, you had to IPO. There was no choice. It's time to go. But Facebook basically, because they were getting so big and they didn't want to IPO at the time, came up with some clever tricks around SPVs. And they would raise money in SPVs as one investor that then looked through hundreds. So it was like a weird way of getting around it. And because that Pandora's box had opened, it meant that we have to re-underwrite the idea of what crowdfunding can be. So the Jobs Act comes along and does a thing that I think does a decent job with patching things up, but it also, I think, made a lot of problems, which is now like private companies stay private for much longer. And the kind of crowdfunded retail access people are getting through like the Republics, the WeFunders, the Seed Invest, those platforms are kind of like adversely selected, and they're not really kind of the ones that most investors would choose to have. And so you have these like 2-lane markets that are happening, and it's at some level, in my opinion, a bit of like a cancer to society because people are not getting the ability to invest in the things early and participate on the upside. What crypto represents truly is everyone should have access to invest in the primary market just as much as the secondary market. And so this idea of then having a retail platform that Kobe has built through Echo and through Sonar being the engine to kind of push Coinbase into that arena is really, really powerful. And if you can then control the plumbing from the primary issuance to the secondary, that's basically tokenization. Because I, as an end investor, don't want to deal with multiple infrastructures of trying to move what I invested in private to the public market and jump through hoops. This still remains one of the biggest problems with traditional markets. When I invest in private companies and they then sit in shares that eventually have to be registered with a transfer agent, and then the transfer agent then has to submit it to a broker who participates in DCCC, there are so many steps you have to go through. And sometimes actually something will break in that process too. Like there are times when a broker dealer says, I actually don't want your shares that you own in your account because the risk department deems it high risk. And you're saying like, what are you talking about? It's my money. What do you mean you can't take it? And the whole point of financial freedom, the way Coinbase is promoting, is to get rid of that kind of discretion, right? And so now we have this conduit that connects the primary market to the secondary market, from retail to institutional, and
level playing field.
All of these things is so good for crypto, so good for the economy in general as well, and for retail investors.
Yeah, it does feel like a much more level playing field.
It does.
It's kind of like, hey, everyone's got a wallet. Right.
Yeah.
Doesn't matter how much money you have in it, who you are, what your experience is, it's a wallet on chain.
Exactly. And part of why the Jobs Act, I think, ultimately doesn't go far enough is because it never reduced the cost of an IPO anyway. And so the whole point of kind of letting people participate early was to find some cost efficiencies. But actually what ended up happening is you just put up so many more barriers, so many more fees and frictions for every company to go through that path, and then investors to feel like they're benefiting from being able to do that. And so the structure is broken. Tokenization, though, like removes every one of those barriers. And so the idea of actually having like true tokenized kind of ownership models in the way Coinbase is trying to build out, this is a turning point. Now, this will also elevate the conversation of what is a security and what is not a security, right? Going back to what crowdfunding ultimately at their core represents, and what Gensler would argue at many times ICO is represented as kind of a securities offering. These kinds of conversations will come back. But I just think it's very healthy that we need to have these conversations, because the other side of it is fairness for retail investors and more transparency for institutional investors as well on the other side of it.
I think it makes a ton of sense. And to me, it's the market is determining where we're going, right? Like people are pulling this.
Yeah.
And you hear people complaining about the accreditation laws and all that kind of stuff, but also they're just saying, well, if I can't do this in the stock market, I'll go and I'll do it in a different market.
Yeah, that's right.
Right.
That's
it's kind of a market-driven solution at the end of the day.
Yeah, that's exactly right.
All right. Where can we send people to find you on the internet?
You can find me on X. My handle is DGT10011. And you can also find me on my Substacks.
Amazing. Well, thank you so much for taking the time. We'll do it again next Wednesday.
Sounds great.